Right now, we believe 15 to 1 demand to supply. In terms of what we see for Blackwell, it's about not just things like in terms of Rubin and others, physical AI, autonomous robotics. And I hear everything that Josh is saying, but in my opinion, we are in year 3 of an 8 to 10 year build out for the AI revolution.
If you think we've already seen the peak of AI, think again. Right now, demand for AI chips is outpacing supply by a staggering 15 to 1. AI isn't just about large language models anymore, it's evolving into something far bigger. With Nvidia's Blackwell architecture, we're moving beyond just AI-powered software and into physical AI applications. Think autonomous robotics, edge computing, and next-gen automation. Whether it's cloud computing, autonomous systems, or generative AI, companies can't get enough of the hardware and compute power needed to fuel their AI ambitions. From self-driving cars to AI-powered robotics in factories, the future of AI isn't just digital, it's physical. We're not looking at a short-term AI hype cycle. The investment in AI infrastructure today is setting the foundation for a decade of innovation and economic shifts.
All right, so Nvidia shares have now pulled back notably, not as much as other mega-cap technology stocks have, but a lot of it was driven by kind of the recent quarterly reports that have come out. The fundamentals are very much intact. Nobody's going to dispute that. But the question is relative to expectations, and that's where Nvidia ran into some problems with its most recent numbers. They're still growing, and by a rapid clip. But why are analysts then so much more bullish where they cannot meet exactly or exceed a lot the expectations that are out there?
I think it's a digestion period. I think we go through the next 4 quarters, you're going to ultimately see, I think street numbers are going to come up 15, 20% over the next few years. I think buy side definitely is very negative here, but as this all plays out, I think it's a stock that has a 2 in front of it. Because the AI revolution, remember, despite DeepSeek in terms of everything we saw there, with some of the Cinderella story in terms of some of the fears in terms of Nvidia on the chip side, there's one chip in the world fueling this, it's Nvidia.
Nvidia's recent pullback has caught the market's attention, but let's be clear, this isn't a fundamental problem. The AI juggernaut is still growing at an incredible pace, and yet, investor expectations seem to be the biggest hurdle right now. No one is questioning its dominance in AI chips, but the market is digesting just how explosive that growth has been. Analysts are bullish, but buy-side sentiment is cautious, waiting to see how AI spending evolves in the next few quarters. The reality? Street estimates could rise by 15 to 20% over the next few years. The AI story isn't slowing down. Despite some concerns about market saturation and competition, there's still one company leading the AI revolution, and it's Nvidia. While some investors hit the brakes, the big picture hasn't changed. The AI revolution is still in full swing, and Nvidia is the engine driving it forward.
This is the cheapest you have been able to buy Nvidia stock since October of 2022, before the launch of ChatGPT, which set off the AI era. So Nvidia in the AI era, as the leading player in AI, has never been a better bargain than it is today. The stock is, the company has 52% growth expectations for this year. It's now a 20 forward PE. How insane is this market right now, where they would rather buy Walmart at 30 some odd times earnings than this at 20? Walmart, if they're lucky, might be growing high single digits this year.
I'd say in 25 years doing this, I can count the times that have been almost the generational opportunities relative to what the stock's doing. That's where I think Nvidia is here.
I think this is a generational
I think
opportunity.
because my view is we're going to be talking about Nvidia 4 trillion, 5 trillion over the coming years, despite near term, in terms of political export controls, everything else. That's where this is going. We're talking about 2 trillion of AI capex next 3 years. There's only one red phone that you could call to get those chips. It's
you want to laugh? You know what he should announce at GTC? How about a buyback? I think that would probably do more good than any technology.
Okay.
It's really, at this valuation, should be shrinking the float.
For investors who have been waiting for the perfect moment to buy into Nvidia, this might just be it. Right now, Nvidia stock is cheaper than it has been since October 2022, before the launch of ChatGPT ignited the AI revolution. 52% growth expectations are in 2024. Nvidia is still the undisputed leader in AI, with demand outpacing supply. The company is forecasting massive revenue growth, yet the market is pricing it at a 20 times forward PE, a valuation that seems almost too good to be true. Investors are willing to buy Walmart at 30 times earnings, while Nvidia, the company fueling AI's $2 trillion capex explosion over the next 3 years, is sitting at 20 times earnings? That's an absurd disconnect from reality. When it comes to AI chips, there's one phone to call, and it's Nvidia. No other company dominates the sector like Jensen Huang's powerhouse does. Whether the future is $4 trillion or $5 trillion, this isn't just about a short-term rally, it's about where Nvidia is headed. The AI-driven future means exponential demand for computing power, and Nvidia is still at the center of it all. Some are calling this a once-in-a-generation opportunity, and they might just be right.
All right, so speaking of the valuation kind of construct, the paradigm that we're in right now, Joe, if you look at the way that it's been described on the forward basis and the valuation that's out there, there is a balancing that's happening right now about whether or not it is the fact that the analyst consensus, the forward earnings expectations for Nvidia are relatively off, or whether it's the price that you pay for those earnings that is relatively off. Do you think, though, that this is the equilibrium point at which the analysts are more correct when you project earnings out in the next year, and is the market valuing those forward projections properly?
So unfortunately, I have to give you an answer that is not succinct, and it is dependent upon the capex. And the question ultimately becomes, does the macro environment begin to arrest the capital spending on the part of those big players? And if in fact that unfolds over the coming year, then when you think about where Nvidia is, I think it has the potential to cheapen its valuation.
Right now, the debate isn't just about how much Nvidia will grow, but rather how much the market is willing to pay for that growth. Analysts are caught in a tug-of-war between forward earnings expectations and the stock's price relative to those earnings. The real wild card here is capital expenditures, or capex. If macroeconomic pressures start to slow down AI spending, then Nvidia's growth could hit some turbulence. But let's be real, AI demand isn't going away. The industry is in the third year of an 8 to 10 year AI build-out, and every major player is still throwing billions into AI infrastructure. If spending slows, Nvidia's valuation could compress further, making it even more of a bargain. At the end of the day, this isn't just another tech cycle, this is the AI revolution. And Nvidia is still sitting at the center of it all.
All right, Dan, if that is the case, the people who spend the most money with Nvidia are hyperscalers. These are the most ginormous balance sheets in the history of corporate world. What does the capex picture change by? How can it be affected by a hypothetical weakening macro backdrop?
Yeah, and Joe brings up an awesome point. I just tell you, come back from Asia, it's actually accelerating. In terms of, we see about 70% of that capex actually accelerating because it's an arms race. In other words, you have $325 billion that's going to be spent by big tech, $100 billion year over year. You don't even have the sovereigns. You don't have the rest of the world. This is something where actually the industry is underestimating capex, and I get the point in terms of worries about macro. I actually see more and more big tech accelerating in terms of, because as this arms race plays out, whether it's M&A from we see Alphabet and others, no one is pausing. They're actually accelerating. And I think that's going to be the key. And I think that's something you're going to hear from Jensen, on stage.
Can I say one thing on this really quickly that I think is important? It's not definitely the case that CFOs are going to look at AI-related capex as a cost too high in a recession, because we're about to have an IPO. Klarna is coming public. Klarna fired everybody, and they're basically operating customer service on AI. That's the story that they're telling at their roadshow. This might be like the poster child for how much money a corporation can save in staffing costs using AI. So it's not a foregone conclusion that a weaker economy necessarily means slashing capex. They might actually look at this as a way to get through a recession.
Forget the doom and gloom scenarios. AI capital expenditures aren't slowing down. They're accelerating. The biggest spenders on Nvidia's technology are hyperscalers. Fresh off a trip to Asia, analysts are seeing something striking. AI spending is actually speeding up. $325 billion, that's how much big tech is expected to invest in AI this year. A $100 billion year-over-year increase, and that number is still rising. Global expansion, this doesn't even account for sovereign nations and corporations outside of the US ramping up their AI investments. This is an arms race, and no one is hitting the brakes. Alphabet, Microsoft, Amazon, and other tech titans are all doubling down. Some might assume a weakening economy would lead CFOs to cut capex, but AI isn't a cost, it's a money saver. The upcoming Klarna IPO is a prime example. They've drastically reduced staffing and are running customer service almost entirely on AI. AI isn't just an investment, it's a survival strategy. Companies may actually increase spending on AI to drive efficiency and cut costs during economic slowdowns.
I would say that when you're driving down the floor to go to the Final Four, this is the jump shot you take 100 times out of 100 times, buying Nvidia in this market at this multiple. And I'll give you two reasons. Really, from the macro standpoint, the survey data has eroded very quickly, historically quick. And that's the uncertainty that's within the market right now. That's the uncertainty that the administration's brought. But I think it's been so quick of an erosion that it's flushed out. And you're starting to see that. I think Atlanta Fed GDP is going to swing back for a number of reasons. And the other side is there's a bigger story. Yes, there's competition with the LLMs, and you're going to see new chat GPTs drop. It's going to be DeepSeek. It's going to be something else. There's going to be another instance. But it's bigger here where you're the robotics story. You're also looking at the software. There's no second. This is their competitive advantage. That's their moat. So this is where I want to buy.
If you're driving down the court with the game on the line, this is the shot you take every single time. Buying Nvidia at this valuation in this market, it's a no-brainer. The macro setup is flushing out weakness. Market uncertainty has been eroding at record speed, historically fast. Yes, volatility has been high, but it's already flushed out much of the downside risk. Atlanta Fed GDP is likely to swing back, bringing renewed confidence in the market. AI is bigger than just LLMs and ChatGPT. The future is autonomous robotics, AI-driven software, and next-gen computing. Competition exists, but there's no true second place. Nvidia remains the dominant force. As AI continues to expand beyond just chatbots and into automation, robotics, and enterprise solutions, Nvidia is positioned to lead every step of the way.
All right, guys, this is Nvidia conversation can go on forever. Let's move on here now. By the way, Nvidia CEO Jensen Huang will be sitting down exclusively with our own Jim Cramer tomorrow at 10:15 a.m. Eastern Time.
Two dynamics is happening at the same time. The first dynamic is that the vast majority of that growth is likely to be accelerated. Meaning, we've known for some time that general purpose computing has run its course, and that we need a new computing approach. And the world is going through a platform shift from hand-coded software running on general purpose computers to machine learning software running on accelerators and GPUs. This way of doing computation is at this point past this tipping point, and we are now seeing the inflection point happening, the inflection happening in the world's data center buildouts. So the first thing is a transition in the way we do computing. Second is an increase in recognition that the future of software requires capital investment. Now, this is a very big idea. Whereas in the past, we wrote the software and we ran it on computers, in the future, the computer is going to generate the tokens for the software. And so the computer has become a generator of tokens, not a retrieval of files. From retrieval-based computing to generative-based computing, from the old way of doing data centers to a new way of building these infrastructure, and I call them AI factories. They're AI factories because it has one job and one job only, generating these incredible tokens that we then reconstitute into music, into words, into videos, into research, into chemicals or proteins. We reconstitute it into all kinds of information of different types. So the world is going through a transition in not just the amount of data centers that will be built, but also how it's built.
The conversation around Nvidia and AI could go on forever, but let's cut to the chase. We are witnessing a fundamental shift in computing, and Nvidia is at the epicenter of it all. Oh, and by the way, if you want more insight straight from the source, Nvidia CEO Jensen Huang will be sitting down exclusively with Jim Cramer tomorrow at 10:15 a.m. Eastern Time. Mark your calendars. For years we relied on hand-coded software running on general-purpose processors, but that era is now over. The world is shifting to machine learning-powered computing, running on accelerators and GPUs. This isn't speculation. We've already passed the tipping point. Data centers are undergoing a massive transformation, built specifically for AI workloads. The next phase of computing is here, faster, more efficient, and fully optimized for AI. This is the big idea in the future. Software won't be written, it will be generated. Instead of computers retrieving files, they will generate AI-driven tokens that become text, music, videos, research, chemicals, proteins, you name it. This new model demands a completely different kind of data center, not just more data centers, but AI-powered factories built for one purpose: generating intelligence. Now, if you found this video valuable and you want to diversify your investments beyond traditional stocks and bonds, I have just the thing for you. Even though I believe that investing in a low-cost index fund is the best long-term investment for the average Joe, the benefits of solid physical gold are hard to deny. I think of physical gold as insurance against unpredictable times, and I'm not the only one. In 2023, central banks added over 1,000 tons of gold to their reserves, the second highest annual purchase in American history. And in 2024, central bank got another 290 tons of gold in just the first 3 months of the year. If the biggest banks in the world are buying tons of gold, I'm sure there's a good reason for it. I found a company that allows ordinary Americans to own and securely store physical bars of gold as part of their IRA account. The best part is that they're giving away a free guide to teach you all about investing in solid physical gold. If you want to learn more about how gold can protect your retirement savings, just click the link in the description to receive a completely free gold IRA guide. Now, if you're tired of these so-called stock market experts blabbing about the same picks over and over again, I've got good news. I found an investing newsletter that completely blows the competition out of the water. They find highly asymmetric stocks with low risk and high reward, the kind you'll never hear about on CNBC or other major stock market news sites. I'm talking about companies like Ukrainian agri-producers during a war, or Bank Handlowy in Poland, a solid bank trading at insanely low valuations. These companies aren't flashy. Many of them produce boring products or provide services in oil and gas, banking, and agriculture. But here's the thing, they make money. And by investing in stocks like these, you can too. For a limited time, they're offering a 30-day trial for just $1. But as a thank you for watching this video to the end, I can do even better. Click the link in the description and tell me your best email address so I can send you their recent newsletter for free. It comes with 5 stock recommendations as well as high-quality market analysis. So make sure you check it out. You've literally got nothing to lose.